Good day, everyone. Welcome back to my channel. My name is Victor Olamide Atunda. Last class, we started our discussion on personal income tax. And in continuation of our last class, we are going to continue the personal income tax. And this is theme, the personal income tax, part 2. Once again, my name is Victor Olamide Atunda. All right. In the previous class, we look into what are the types of personal income tax, whereby we're able to look, okay, the types of personal income tax. We see that personal income tax is subdivided into the non-taxable income and taxable income. But for computation purposes, people have been seeing a lot of people saying that what we charge our taxes on is our taxable income. But to give a clear understanding of this, the difference between the taxable income and chargeable income, because the taxable income is the tax base, that is what we are levied tax on, but the chargeable income is the final tax base. By final tax base, we mean what we are charging tax on. So there is a difference between being subject to tax and being charged to tax. So the income that we're subjected to tax, by subjected to tax, we mean that is covered by the scope of taxation, is what we refer to as taxable income. Why the whole or the part of that taxable income upon which tax is finally levied is what we refer to as chargeable income. And in order for you to have this clear understanding, that is why this class is what is structured. So to have this clear understanding, what is that? So we are going to be looking into the income, individual income. What is this flow from the taxable income, from the normal income of a person to the chargeable income, which is the final income upon which the tax is levied. So if we deduct the inherent not taxable income, that is, what is inherent not taxable income? These are not taxable income by nature. They are what we call their income that is not within the scope of taxation. Income that are not subjected to tax. By being subjected to tax, I mentioned earlier, these income are not captured under the scope of taxation. That is, they are not within the legal meaning of what we call taxable income. So for this fact, when we deduct our what we call inherent not taxable income, which is part of the not taxable income that we mentioned in our previous class. If you've not watched my previous video, do well to go and watch the previous video for you to have the better understanding of what we refer to as what we call inherent not taxable income. So what are these inherent not taxable income? In our previous class, we discuss, we label them such as the gift, donation, charitable support, crowdfunding, personal assistance, family support. A best understanding of this was discussed in our previous class. Please do it to watch the video. Why? Because when your parents, your friends, or because of personal relationship, you receive a gift. Such gift is not taxable. So far, it is not within the definitions of what of taxable income. So if we now deduct this inherent non-taxable income from the total income of a person, what is going to remain is what we first as taxable income. So we can just say that the taxable income are income that are captured under the scope of taxation. Anyone that is not captured under the scope of taxation is what we refer to as inherent non-taxable income. And this inherent non-taxable income, in other normal circumstances, that's what we refer to as not taxable income. So our major focus is what we refer to as this taxable income. So this for taxable income, we can also say the taxable income when we deduct the total deductions. What are these total deductions according to the law? We have the loss relief allowance, we have the capital allowance, we have the statutory exempt income, and the frank investment income. This for when we deduct the loss relief, maybe in the previous in the previous accounting years of a business, the business incurs some losses, or as a person, you incur some losses from your trade. Such losses is available for relief. We call them carry forward loss relief, and can be relief against the same income of the same sources in the subsequent period, or in the case whereby you are incurring loss in any of your let's just say in your trade, and there's any in your trade, and there is what we refer to as there's other sources of income, and these losses can be relieved against other sources of income in the period in which you incur the loss. We call it current year loss relief. But in a case whereby you're unable to relieve that loss in the current year, in the subsequent period, this loss cannot be relieved against other sources except the same sources where the income is incurred. So we are still going to see how these things relate, and we have the capital allowance. This is what we call the standardized depreciation, the standardized form of depreciation, which the law permitted individuals or businesses, or either individuals or corporate entities to claim in a year of assessment. So this depends on the consensus of agreement between the relevant tax authorities and the taxpayer. So these are the things we are going to look into when we are doing calculation. But for you to have the better understanding, that is when I'm bringing this to your notice. And another thing is what we call statutory exempt income. That's what we call what we refer to as not taxable income by exemption. So this is the second types of the not taxable income that we mentioned earlier when we are discussing the types of income. But we are still going to see that. I'm still going to reference this in my discussion. And the frank investment income. And frank investment income is what we call income upon which the final tax payable is what we call frank investment income. That is, the final tax payable is withholding tax. Let me take that again. The frank investment income refers to the income upon which the final tax payable is the withholding tax, and that is what we refer to as dividend. Dividend is what we consider as a frank investment income. So because they are income upon which the final tax payable is what is withholding tax, so they are not going to be subject to further tax again, since withholding tax has been deducted from such income. And when such income has already suffered withholding tax, such income will not be subject to further tax under personal income tax or any other income tax again. That is what we refer to as a frank investment income. So moving forward, when we deduct the total deductions from the taxable income, what is going to remain is what we refer to as our total income. So the total income, suffice to say that the total income is equal to the taxable income minus the total deductions. So from this taxable total income as well, we can also say we are going to deduct the eligible deductions. You see the flow. So when we deduct the eligible deductions, what are these eligible deductions? These are the what is labeled out under the Nigeria Tax Act to include the National Housing Fund contribution. That is the contribution made by individuals to National Housing Fund, the contribution made to National Health Insurance Scheme, the contribution makes to the pension contributions under Reform Act, mortgage interest, life assurance premium, and the rent relief allowance. We are still going to discuss this, what we mean by these eligible deductions. These eligible deductions, you have to claim these eligible deductions before it's going to be granted to you. So let's assume that all these eligible deductions that was listed out, these eligible deduction like NHFC, NHIS, the pension that is made in accordance with Pension Reform Act, the mortgage interest, the life assurance premiums, and rent relief allowance, all these things are available for you. If it is available for you, then we are going to say, okay, when we subtract all this eligible deduction from our total income, what we're going to have is what we call the chargeable income. So this chargeable income is what we subject to tax. What we subject to tax is the chargeable income, not the let me take that again. What we charge to tax is what we call the chargeable income, not the taxable income. Taxable income is what we subject to tax, but the part of the taxable income which is charged to tax is what we refer to as the chargeable income. So you could see that is not your taxable income. You can be making your taxable income, maybe your total taxable income in a year is 1.2 million. After we deduct these total deductions, which is loss relief, capital allowance, statutory exempt income, frank investment income, and also we deduct our eligible deductions, which consist of the National Housing Fund contribution, the National Health Insurance Scheme, pensions, mortgage, interest, life assurance premium, and rent relief allowance from our taxable income. When we deduct the total deduction and eligible deduction, the result that we are going to be having is chargeable income. So the part of this taxable income, it's part of this taxable income, or we can say the whole or part of this taxable income which is charged to tax, that is upon which tax is levied, upon which tax is charged or levied, is what we refer to as chargeable income. So meanwhile, in some cases it is possible your taxable income is equal to your chargeable income. That's when we don't have total deductions, there's no eligible deductions. Maybe those eligible deductions you are not eligible for them, or you don't make any contribution with respect to all these listed eligible deductions, or the total deductions that we initially mentioned. You don't have you don't enjoy them in your in the computation. As a result of that, your taxable income can be equal to your chargeable income. In this stance, your taxable income can be said to be the amount that is charged to tax. But in most cases, your taxable income is not always the same as the chargeable income. But in some instances, it can be equal to chargeable income. And I've mentioned what can result to a situation whereby you have your taxable income be equal to your chargeable income. That's when we don't have total deductions and eligible deduction. But in case we have total deduction and eligible deductions, your taxable income and your chargeable income will be different. So the chargeable income is the part or whole of the taxable income which is charged to tax. By charge to tax is what we apportioned the tax rates to get our taxes. So what is the tax rate? For the tax rates for the new current provision, that is a provision that under the Reform Act which was made in 2025. So the Nigeria Tax Reform Act mentioned that we have the following new tax rate and band. Okay, the first 800,000 is exempted to tax. So first 800,000 is applicable to your chargeable income. When you have a chargeable income in a year of assessment that is less than or equal to 800,000, the appropriate tax rate is 0%. But in case you have an income in a year of assessment greater than 800,000, let's assume it is 3 million. So the first 800,000 here out of that 3 million is going to be exempted from tax. So the first 800,000 is appropriate rate that we are going to use is 0%. But amount in excess of this 800,000 is going to be levied on the tax is going to be levied on that if it is 2.2 million above that 800,000. Suffice to say, you have a taxable income for the year of assessments to be 3 million, and if we said a first 800,000 here out of it for the first year is exempted, it's not going to be subject to tax. What is going to remain? It's going to remain 2.2 million. That 2.2 million on it is going to attract 15% tax rates. But let me also take another note. For instance, let's assume the amount of your chargeable income in a year of assessment is 1.2. In this 1.2, let's say the first 800,000 is not going to be charged to tax. It's not going to be charged to tax. So removing 800,000 from 1.2, which happen to be your chargeable gain, what is going to remain is what is going to remain 400,000. It is this 400,000 that is going to be attract 15% tax rates. So the 15% tax rate is going to levy on that 400,000. So the amount you are going to pay if your total income is 1.2, your chargeable income rather is 1.2, is one on that 400,000 in excess of 800,000. That's what we are going to pay 15%. But let's what's now in some cases whereby your chargeable gain or chargeable income rather, your chargeable income in a year of assessment is greater than 3 million. So if it is greater than 3 million, so in that first cases, we are going to say the first two tax band, we said the first 800,000 is 0%, and the next 2.2 million is going to be attract 15%. So if it's now in excess, how much is in excess of that 3 million? Let's say it is 9 million in excess. 9 million in excess. If it's captured within 9 million in excess, that simply means the total taxable income, let's say the total chargeable income rather, the total chargeable income for that period, let's say it is 12 million. We are looking into, let's say it's 12 million. So we said, okay, the first 800,000, the first 800,000 is 0%. The next 2.2 million in excess of 800,000, which is 15%. That simply means 3 million has already been subjected to tax. What we mean out of 12 million is going to be 9 million. So that's what we are trying to say. So any amount in excess of that 3 million, which has already been apportioned to tax at 0% and 15%, with the amount in excess, which is capture within 9 million in excess of that 3 million already subject to the tax, is going to attract 18%. That is the next 9 million is going to attract 18%. So and as well, even in case we look, okay, we have an order in we have the chargeable income greater than 12 million, and which is greater than 12 million. So let's assume that, okay, if it's greater than 12 million, I already be apportioned to tax at 800,000, 2.2 million, 9 million, which is apportioned initially. Let's say it is 13 million in excess of that already apportioned to tax income. What are the apportioned to tax income, which is 12 million, which if we had 9 million, 2.2 million, and 800, if it's now 13 million in excess of that 2 million, if it's the income is found within that scope, within that band, or within that tax band, the amount is going to be subject to tax at 21%. This is going to be attracted to tax at 21%. Let's now see some cases. If we look, the 800,000, 2.2 million, 9 million, and 13 million, if we calculate, add them together, you see that the amount that was already subjected to tax is what? Is 25 million. If now we now say, okay, let's say we have additional income which is in excess of that 25 million already subjected to tax, and that amount is within another next tax band. The next tax band is what? The next 25 million. That is 25 is the income is found within 25 million. Not necessarily it should be only 25 million. That is it is above 25 million, but it's 25 million above 25 million. That is, it's found within 25 billion above 25 million. So that is going to attract 23%. So if we now see, oh, this 23%, then this and what we've already subjected to tax, if we add 25 million plus 13 million plus 9 million for 2.2 million plus 800,000, it's going to give us 50 million. So that's simply 50 million has already been apportioned to tax rate, and we've already calculated the normal tax on it. So any amount in excess of that, whatever the amount is going, whatever the chargeable income that remain that has not been apportioned to tax, that remain in excess of that 50 million that has already been apportioned to tax, amount in excess is going to attract 25%, and that, if we add everything together, is what will result in what we refer to as our taxes. So when we add all these things together, all these the taxes that we got from the apportionment of a tax rate on the chargeable income is what we refer to as what? As our tax. That's what we refer to as our tax. That's what we are going to be looking into today. So let's take them one after the other and understand this income, because I would like to quickly reference what we discussed in the previous class as regards to the income of an individual, which we refer to as personal income. So what is this personal income? So the individual income, in the previous class we said individual income is a total is the total of all earnings. That is the total earnings you make, your gains, your receipts and benefits, whether that receipt or benefit is in kind or is in cash, which you received or it is accrued to you as an individual from all sources during a period. So this type of income that we are talking about include the salaries, the wages, the bonuses and allowances, the gifts and donations, the stipends and allowances. So all these things, that's what constitutes your income as an individual. As we have what we call businesses and professional income, rent, interest and dividend, support from your families or from a benefactors. You see a support from a benefactors or compensations, or we have benefits and other receipts. So all these things are what we refer to as the income of an individual. So don't forget, part of this income of an individual is what we refer to as not taxable. They are not taxable by nature. That's the reason why we said, okay, the individual's income is divided into two. In the previous class, we said it's divided into the not taxable income and the taxable income. So the not taxable income is also divided into two. That's where we look the inherent not taxable income and the not taxable income by exemption. This not taxable income by exemption, we said it is also known as statutory exempt income. Under normal circumstances, this not taxable income by exemption, they are taxable, but by the virtue of meeting some criteria in the law, by meeting the criteria in the law, they are exempted from tax. That is, what we mean by this not taxable income by exemption is that under normal circumstances, they are taxable. If these criteria or condition that this income melts is not available, such income would have been charged to tax directly. But due to the fact that they meet some criteria or some conditions, or because of some conditions stated under the tax law, they are exempted from tax. Those income that are exempted from tax by the virtues of meeting some criteria or condition in the of the law is why we refer to them as what we call statutory exempt income. But those ones that by their nature they are outside the tax scope, they are outside the scope of taxation, they are not subject to tax. By mean they are not subject to tax, it means they are outside the scope of taxation. By that fact, so they are what we refer to as inherent not taxable income. So the inherent not taxable income are those ones that are not taxable by nature, and so they did not fall within the scope of taxations, and that is why we say they did not meet the legal meaning of taxable income. But those ones that meet the legal meaning of taxable income, but by the virtue of their meeting the conditions stated in the tax law, they are exempted. They are exempted from taxes. That's why we call them statutory exempt income. And their major focus is going to be on taxable income. Don't forget, our major focus is going to be on taxable income. Our major focus is going to be on taxable income. And what we said, the taxable income is the income subject to tax. So in accordance with the section 28 subsection 2A of the Nigeria Tax Act 2025, our taxable income is what? Our taxable income is the income that is subject to tax. Is income that is subject to tax. Moving forward, so we have this income. So let's say, so for calculation base, we want to look into the flow that I mentioned earlier. For calculation base, we said the inherent non taxable income. So this inherent non taxable income that we said, it constitutes the gift, the donation, the charitable support, crowdfunding, personal assistance, and family support. So we've already discussed this in the previous video. You can do well to look into it. So when we now deduct this, from our total income of an individual, what we are going to have is what we refer to as taxable income. So what we are taxing is not, or what we want to subject to tax is not the whole of the income of an individual. It is those ones that fall within the scope of taxation. For this fact, so you are to file returns on any income that fall within the scope of taxation. But those ones that fall outside the scope of taxation, you are not expected to file returns in their regard, because they did not meet up with the definition, or we did not meet up with the criteria of being taxable. So we call them the irrelevant non taxable income. So you are not expected to file returns. By filing returns is to provide necessary information in respect to such income that you received or earned, providing their sources, providing the normal information in respect to tax that you've already deducted. So that's what we mean by filing of returns. Filing of returns is providing necessary information to relevant tax authorities about the sources of income, the amount of income charge, the amount of capital allowance computed, and some other information which will help the relevant tax authority to determine the amount of taxes that you're expected to pay. So this inherent non-taxable income, since it does not meet the definition of not taxable income, they are what? You are not expected to file returns. You are not expected to file returns in their regard. But for that taxable income, so far this income fall within the taxable income, you are expected to file returns in their regard. You are expected to file returns in their regard. For this fact, for this case, you are expected to file returns in their what? In their regard. So moving forward. So what is now this taxable income? Let's look into what is this taxable income. So the taxable income, in the previous class we said, okay, taxable income refers to the total income, profits, and gains of an individual from all sources, which the tax law recognizes as liable to tax within a basis period, whether or not such income will eventually be taxed after relief and exemption. You know, it is possible that you have an income. It is what? It is subjected to tax, but at the end of everything, we say, okay, this income should not be what? Should not be charged to tax. So for instance, if we discovered, okay, the total income, for instance, a person that the total taxable income in a period is less than or equal to 800,000. From the beginning, such income is what is going to enjoy what we call is going to apportion to tax at 0%, automatically is exempted from tax. So because 800,000 naira under normal circumstances, if you want to continue to deduct all the eligible deductions and all of that, this thing is still going to fall below the 800,000 naira. From the beginning, that's already fall below, because don't forget, but this 800,000 naira that we are capturing for chargeability, that is, we want to subject the taxes on chargeable income. So the chargeable income is what we said is if it is less than or equal to 800,000. But from the beginning, taxable income is less than or equal to 800,000 naira, automatically is exempted from tax. But let's in a situation whereby an income is 1.2 million, 1.3 million, 1.5 million, or 2 million naira, as the case may be, and when we compute the deductions and eligible deduction and the likes, and the amount that is available as chargeable income is let's say it's less than or equal to 800,000, such income also is not going to be what? Is not going to be charged to tax. So it is taxable at the beginning. So such income is taxable at the beginning, but by the virtue of falling within a threshold of 800,000, they are exempted from tax. Such kind of income is what such kind of income is not eventually being taxed. As a result of that, we call it statutory exempt income. So that's why they said whether or not such income will eventually be taxed after relief and exemptions. But however, the taxable income is income that we recognize under the law that should be subject to tax. That is, or upon which tax may be paid, or upon which tax may be levied. That is what we refer to as taxable income. But the income upon which tax is later levied, that is, the income upon which tax is levied, is what we refer to as chargeable income. I'm still going to differentiate better for you after we look into this calculation. So moving forward, we can now say the taxable income answers the question of which income is legally capable of being taxed. So the question that is asking is, okay, which income is considered to be legally capable of what? Of being taxed. That's the question it's asking, and it's going to is going to list them. That's why we said taxable income is therefore the legal classification of income, not the amount or on which the tax is paid. That is when we said the classification. So when if it's answered the question, which income is legally capable of being taxed, that is why the taxable income. That's why section 28 subsection 2A of Nigeria Tax Act 2025 answered that question, that okay, if what the question that the taxable income is asking is which income is legally capable of being taxed. Section 28 subsection 2A now say, okay, these are the answers to that question. The answers to that question is that, okay, we have the assessable profit. The assessable profit I explained the assessable profits for you in the previous class. So the assessable profits, assessable profits refers to what we call the profits, the accounting profits from the either trade, from businesses, operation, businesses, profession, vocation, which is determined in accordance with the tax law, and which is assessed to what? To tax, whether the part or the whole, which is adjusted for tax purposes and later assessed for tax purposes. Let me do that again. So assessable profit refers to the accounting profit which is adjusted for tax purpose, and which is the part of which is assessed to what? The assessed to tax. Well, let me quickly address some things here. The difference between what we call accounting profits, adjusted profit, and assessable profits. So the accounting profits is the profits that is being computed in accordance with the accounting principles and laws. The accounting profits which is now being adjusted to fit in the tax purposes is what we call the adjusted profits. Adjusted profit or adjusted income. So the part or the whole of this adjusted profit which is now being assessed to tax in the period of assessment is what we call the assessable profit. So there's level to the calculation of this assessable profit, of which we are still going to capture in our class. So the assessable profit, which is a part of or the whole of the adjusted profit which is assessed to tax in a year of assessment, is what it refers to as a taxable income from what? From trade, from businesses, from profession, from occupation or vocation. That is why we said, which is determined in accordance with part 5 of the chapter 2 of this act. We are still going to discuss that. So another thing is the employment income, what we refer to as income from the cash emolument and the in-kind emolument. The cash emoluments are those ones who receive in cash, such as the salaries or wages, the bonuses, allowances, and the or is it perquisite? By perquisite we mean the benefit in kind, which is maybe in terms of expenditure base, or it can be capital expenditure base. It may be a revenue expenditure base which refers to expenses based, or it may be a capital expenditure base which we consider to be in form of assets. We call them asset based or expenses based. If by expenses based we mean revenue expenditure based, by asset based we mean it is capital expenditure based. By capital expenditure based is that they provide you with car, houses, and the likes. So these are what we call benefit in kind we enjoy from employment. All these things constitute to employment income. We are still going to discuss this in details when we are doing the calculation. We are going to see how these things apply, but we've already discussed them in our previous class under the explanation. If you have not watched the previous class, please go and watch the previous class video. So another income that it is mentioned under the tax scope is what we refer to as the income from investment activities, which constitutes the rent, dividend, royalties, interest, and other similar income of similar nature. So other income of similar nature which can be considered which we can consider to be part of investment income are what we refer to as what? Investment income. That is income from investment activities, which include the rent, the dividend, the royalty, the interest. All these things are our investment income. And moving forward, another thing is what's called profit or income from other sources. So from any other sources, income you received or you receive from any other sources which are also taxable. For instance, you are performing a duty which is not something of continuous base. For instance, it's just one time you see a work and you venture into it and you receive an income from it. So such kind of income is also taxable. So what we are trying to put here is that in this subsection 4 of the section 28 subsection 2a of the Nigeria Tax Act, which sits under the profits or income from any other sources. It's trying to tell you that any income that is not captured in the above listed sources, such as civil profits, income from employment, income from investment, or from chargeable gains. Such income should fit in under profit or income from any other sources. That is why we put that clause. That clause is to ensure that no income is escaping taxes. For instance, you're a freelancer, you may not be fit in the other mentioned categories of income. Then you'll be fit in under this type of income. That's why we put it there. Another income is what we call chargeable gain arising from disposal of chargeable assets. Initially, we use the term chargeable gain here rather than using capital gain, because there are some situations, there are some exemptions, there are some conditions stated under the tax law that states that, okay, when there is a sales in the capital market, that is sales of shares in the capital market for a period in a year of assessment or in a 12-month, which is less than which the capital gain is less than or equal to 10 million naira, such capital gain should not be subjected to tax. Any amount in excess of this capital gain from a capital market, from a sales of shares, such amount in excess of 10 million, that amount should be subjected to tax, should be subjected or charged to tax, should be charged to tax. In that case, so we consider that to be a chargeable income. We consider that amount in excess of that of the threshold to be a chargeable gain. Or in a situation whereby you receive income from employment in the respect to from termination income from employment rather. So for instance, we have when an income is given as a result of loss of office or for damages resulting from employment, such income, if it's not greater than the provision which is made recently to be 100 million. If it's not greater than 100 million, if not greater than 100 million, so such income is exempted from tax. But in the case whereby it is above 100 million, amounts in above that of 100 million should be charged to tax. So we call it chargeable gain. So that's another case. Another thing that I should also have mentioned under when I was explaining the capital market is that don't forget that there should major threshold that, okay, the total capital sales in the capital market is less than or equal to 150 million, or the total chargeable gain is less than or equal to 10 million. In such cases, such capital gain made is exempted from tax. So those are the things, so that the condition that are stated. So that is why we're using chargeable gain. Initially, chargeable gain or capital gain rather is normally captured under capital gain tax as a separate tax, but under the new tax provision is now being captured as part of the personal income tax. So there is no more separate taxation for capital gain tax. So from capital gain, it is now being captured as part of what we refer to as personal income. So that is why you see it is labeled as chargeable gain arising from disposal of chargeable assets. So this to say that taxable income is the total income, profit, and gain derived by a person from all chargeable sources within a basis period, which the tax law expressly subject to tax. So we can now say we can now say that the taxable income is the income that is what? That is subject to tax in accordance with Section 28, Subsection 2A of Nigeria Tax Act 2025. So for better clarity and for computation purposes, we can also subdivide this taxable income into two. We can subdivide this taxable income into two, and these are earned income and the unearned income. So we can say what we've labeled, what we've listed under the tax law to have been our taxable income, we can also say they can be divided into the earned income and unearned income. And what is earned income? Earned income are income you received or earned arising, let me just say, their income arising from the active effort or services. That is, these are the income you received from your active involvement. Those income you received from active involvement are what we refer to as earned income. We can just say that earned income are income that you receive from employment, from businesses, from trade, from vocation, from occupation. So employment income are what we refer to as earned income. Earned income are income arising from employment, from businesses, from trade, from profession, from vocation or occupation. These income are what we refer to as earned income. Or earned income, in the other hand, will now be considered to be any income other than that of earned income, are to be what we regarded to as what? Or earned income. Any income other than that of what? Other than that of earned income are what we refer to as what we call or earned income. So this income arises or earned as without labor or active involvement. So that is where most of passive income are what we refer to as what we call or earned income. So, but this income are earned without labor, but from capital or property. They are earned as a result of from a capital or property, and this income is subject to tax, and this income rather is divided into two. This income is divided into two. That's why we capture them as what? The chargeable gains as from disposal of chargeable asset, and that of what we call investment income. So the earned income constitutes the chargeable gains and investment income based on the new provisions of the law. So, and what are these investment income? As listed earlier, this constitutes the rents income, which we refer to as rental income. The rent income received from rent, which is referred to as rental income. We have the dividend received, we have the interest received, and royalties received. When you advance loans to person, or when you ventured or you invested in what you call the bonds, government bonds, or you invested in bonds, or you invested in treasury bills, the interest received, the interest received from that, or for advancing loan from people, is what we refer to as your interest income. Even though there are still some exemptions that we are going to look into under the tax law. Another thing is royalty. The royalty also part of the investment income. So these are what constitutes your investment income, and the whole of this is what we refer to as what we call the taxable income. The total taxable income, these are the words when you add the earned income and earned income together, is what constitutes your taxable income. When we are doing a simplified calculation, you are going to see why we are going to group them into earned income, and we are going to group them into earned income. So moving forward, now let's look for our calculation base. Don't forget, in our previous calculation we stopped at the rent income. When we said the rent income is subtracted from the taxable income, we now say okay, we subtracted from the total income of an individual. That's when we get what we refer to as taxable income. So for this taxable income as well, we said okay, we are going to first deduct is what we call our total deductions. And what is these our total deductions? Our total deduction, what is this total deduction? Let's look into what total deductions means. According to Section 28, Subsection 2B of the Nigeria Tax Act 2025, define the total deductions as the sum of earning losses ascertained in accordance with the Section 2 So, in accordance with the section 2 that I mentioned, section 2A that I mentioned earlier, in accordance with section 2A that we mentioned earlier, as regards to what we call losses, as regards to what we refer to as taxable income. So, any losses ascertained in accordance with the section 2, subsection 2 rather, in accordance with subsection 2A, we now say such losses are what we call are available for relief. That is why any losses ascertained in accordance with that should be what? Should be part of what we are going to be deducted. That is why we refer to them as what we call loss relief allowance. That's why we refer to them as loss relief allowance. So the first thing to deduct from your from your taxable income is to, in case you have any losses that it was incurred in respect to any of your in respect to any of the income that is earned in a period. So such losses, maybe in the previous year you incur losses on your trade. So carry forward loss relief is available for that trade. So you can relieve the losses you incurred in the previous year from what refers to as your taxable income. Another thing is what we refer to as capital allowance in accordance with the provision of the Part 1 of the first schedule. That is why we call this capital allowance. So the capital allowance, don't forget, I mentioned this to you as a form of standardized depreciation. So that is why we list it under our total deductions to be a capital allowance. It's part of the list that we deducted. Another thing is income of the individuals. Income of the individual that is exempted from tax under this act. So, and don't forget, those income that is exempted from tax under this tax, under the act, is what we refer to as statutory exempt income, which we consider as not taxable income by exemption. So, not taxable by exemption, which is also known as statutory exempt income, is part of the things we are going to deduct from our taxable income to know what is going to be the total income that is available to be subject to further tax. So another thing is that also captured or fit in to be deducted is what we call income of the individuals on which tax deducted at all under tax deducted at all under the section 51 of Nigeria Tax Act and Nigeria Tax Administration Act 2025 is the final tax. That's what we call frank investment income. This frank investment income upon which further tax cannot be charged after being subject to withholding tax has already been deducted on them, and this is what we call dividend. When you receive a dividend and that dividend is already suffered a withholding tax, such dividend should not be subject to further tax again, and dividend is going to be considered as a frank investment income, so it's going to be subtracted. Don't forget, under normal circumstance, the dividend has already been captured as part of our taxable income, and don't forget, it has already suffered what's called withholding tax. So as a result of that, we should exempt it from further tax. But this is not applicable to other income like this is not applicable to other income like interest, rent, royalties, because they are not seen to be a frank investment income. Such income can also be subject to further tax. In case of that withholding tax has already been suffered, at the end of calculation of the taxable income, we subtract that withholding tax that already suffered from that to get to know the amount of next tax to be paid. We are going to see how these things relate. So these total deductions that we said, it constitutes what we call loss relief, capital allowance, statutory exempt income, and frank investment income. When we subtract it from your taxable income, is going to result in what we call our total income. That is why the law says that the total income, according to section 28 subsection 2, section 28 subsection 1 rather, section 28 subsection 1 of the Nigeria Tax Act 2025, define the total income of an individual for a year of assessments as the taxable income less total deduction. So you see, for computation purposes, your total income is now equal to your taxable income minus your total deduction. So to get our total income, so taxable income minus the total deduction is going to give us what we refer to as our total income. So don't forget what we initially mentioned to constitute our taxable income. These are the end income and end income. When we add it together in the calculation, then we subtract this total deductions, total deduction in accordance with section 28 subsection 2b of the Nigeria Tax Act, then we are going to result in what we refer to as what we call our taxable, our total income, which is the definition given in accordance with section 28 subsection 1 of the Nigeria Tax Act 2025. So the total income is equal to taxable income minus the total deduction. Okay, moving forward. So after we've already gotten our total income, there's another further further deductions that we can also deduce to get before we now say, okay, these amounts we are charging to tax. So that deductions earlier mentioned when we start our class is what we refer to as eligible deduction. So what is now these eligible deductions? Those are the things we want to consider now. What are the things that constitute these eligible deductions? So eligible deductions, what is eligible deductions? According to section 30 subsection 2a of the Nigeria Tax Act 2025 defined eligible deductions as the payment made by individuals in a year of assessment in respect of what are the things that are listed to be captured under the eligible deductions. So these are the things we have what we call the in accordance with subsection 1 of the section 30 subsection 2a of Nigeria Tax Act 2025. So the subsection 1 states that it is the individual contributions under the National Housing Fund contribution. This is what we call National Housing Fund contribution, NHFC. The contribution to the NHFC, which is the 2.5% of the basic salary, it is initially mandated for persons in the self-employed person person in the employment and self-employed to contribute that towards the securing a good house to live. So but now under the new revised provision, such contribution is not mandated. It's not mandated for individuals in private sectors. So we can say that, okay, individuals in private sectors may choose to opt in or opt out of the scheme, but it is still mandated for individuals that are into public servants, that is into public services. So they are like government workers are still mandated to contribute this 2.5% of their basic salary. Another thing that we can also mention under the new provision is that the new provision also mentioned that another deductions that can also be made is what in respect to eligible deductions is what we refer to as the individual contributions under the National Health Insurance Scheme. The individual contribution under the health insurance scheme is what refers to the contribution made by the taxable persons in respect to the National Health Insurance Scheme in accordance with the National Health Insurance Scheme Act cap N42/11/2004, which states that in a public sector employee, like let me just say federal government employee, the federal government employee is expected to contribute 1.75% of their basic salary, while the government, the federal government is expected to contribute 3.2% of their basic salary. And if we add the two together, it's going to be equal to 5% of the employee consolidated salary. So in this case, employee which are in federal government appointments or in the federal government services, that is, they are federal government workers. Such employees expected to contribute 1.75% of their basic salary to what refers to as NHIS, which is the National Health Insurance Scheme, what refers to as National Health Insurance Scheme, and if that employee is into which is private sectors or that of the state government, that is, we call them non-federal public non-federal government employees. So any employee in the private sector or that of the individuals in the non federal government employment, that is the state government employment or local government employment. Such employees expected to contribute 5% of their basic salary to the what, to the NHIS. So, and this and the employer, who happen to be the private companies or the state government, are expected to contribute 10%. And if we add the two together, it's going to be 15%. But that one that is applicable to the individuals as employee is what, is the 5% of their what, of their basic salary. 5% of their basic salary for individuals in private sectors, and that of the non-federal government employees, which we refer to as the state government or local government, as the case may be. And it is important to also point out here that this one is still what, is still compulsory. This one is still compulsory to make. Is a compulsory contribution that is expected to make. So another eligible deduction is what we refer to as the individual contribution to the pensions reform to the pension reform act. That is the individual contribution as what, as pension. An individual that contributes a month to what, to the national pension scheme, we call it national pension scheme, so we call it pension. Amount you contributed to pension should be 8% of your monthly gross emolument. And what to mean by monthly gross emolument is what constitutes what we call your basic salary plus your housing allowance plus your what, plus your transport allowance. So the addition of these housing and basic salaries, housing allowance and transport allowance is what we refer to as a what, as your gross emolument, your monthly gross emolument. So you have to contribute 8% of the what, of the grand totals of the monthly gross emolument as what, as an employee. So the employee is expected to contribute 8% of what, of the monthly gross emoluments for and in the case of the private and the public sector, so they are what, they also contribute 8% of their gross monthly emoluments, while the employer of such individuals are expected to contribute what we refer to as 10% of the monthly gross emolument as the employer's contribution. But this is for the employer case, but what is actually applicable to the individual is 8% of their what we call their monthly gross emolument. 8% of the monthly gross emolument. So moving forward, so that is what we refer to as pension contribution in accordance with the Pension Reform Act. So that pension must be made in accordance with the Pension Reform Act. So moving forward, somebody is asking that, is it possible for somebody to contribute more than 8% for that pension? Yes, it is possible that you contribute more than the Pension Reform Act. We call it additional contribution. So this additional contribution, if it is made in accordance with the Pension Reform Act, it may be allowed for tax purposes. Or if it is made in accordance with the Pension Reform Act, it may be part that the tax authority may be allowed. If the tax authority sees that this amount additional contribution you make, you are doing it in order for you to what? In order for you to evade tax, they may be what? They may decide to only allow part and not allow all. But in most cases, the whole amount you contributed in accordance with the additional pension contribution you made in accordance with the Pension Reform Act may be allowed for tax purposes. Depend on the discretion of the relevant tax authority. So another eligible deduction is what we refer to as interest on loan for developing owner-occupied residential. So owner-occupied residential, for instance, we call it interest on mortgage. So interest on mortgage, amount you contributed as what? As interest on mortgage is allowed. That is, for instance, this one is not a contribution. For instance, you are building you opting for a loan, which the loan is for you to what? To build an house whereby you are going to be living. Not for commercial purposes, not for the one that you are going to use for rentage, but the one you are going to be living in as an individual. So when you take that loan, the amount of interest you paid on that loan, it is allowable for tax purposes. So it is part of eligible deduction that is going to what you are going to deduct. So we call it interest on mortgage. This interest on mortgage, it is allowed in the tax law as part of the eligible deductions, but it's not automatic. All these eligible deductions I mentioned earlier, it must be what? It must be claimed. You are expected to claim them, make a written claim to relevant tax authority before they can grant you to what? Before they can grant you such eligible deductions to be part of what is going to be allowed to be deducted for tax purposes. So interest on mortgage, any interest you incurred on the loan you opting for or you collected for you developing your house that you are going to live in, not the one that you are going to be using for commercial purposes. If you are the one that are going to be using for commercial purposes, it's not allowed. But for which you want to be living in such that you are going to be the only one to occupy it as owner occupied house, so such interest is what is allowable in the tax law to be part of the eligible deduction. Another thing where we are going to look into is what we call annual amount of any annuity or premium paid by individuals during the year preceding the year of assessment in respect to insurance of his life or other or the life of his spouse, or contracts for a deferred annuity or his life or the life of his spouse. Let me just explain what this is trying to say. I'm trying to say this is life assurance premium, is what we refer to as life assurance premium. So, and life assurance premium is allowable, it is part of the eligible deductions, whereby when a person make an annual payment, what refers to as a premium, you paid to to insure your life. So that's life assurance. When you insure your life or the life of your spouse, you are it is allowed, it is part of the eligible deduction. But when in a case whereby the insured, when you insured your life for a period more than a year, and that amount you paid the amount you paid is, let's just say, within 5 years. So we are going to divide that amount by what? We are going to divide it by the numbers of the year that you paid for. For instance, you paid for life insurance for, let's just say, 3 years. So the amount we are going to capture in a year of assessment is that of what's going to be that amount. The total amount you pay divided by 3 years is going to be captured for the year in which it relates to. So we are going to capture it for each of the year, not the entire amount you pay. That is why we said annuity. So don't forget, annuity is an annual payment you make. So in case you are making an annuity payment, you are making an annuity payment which span more than 1 year. For instance, for 2 years, 3 years, 4 years. If it's 4 years, we divide by the 4 years. If it's 5 years, we divide. But in the case whereby it is greater than 5 years, we divide by what? Is divided by what? 5 years. We consider it to be the annuity to be made for a period of what? Of 5 years. So that as the case may be in practice, as the case may be. So another eligible deduction is what we refer to as the rent relief allowance. So the rent relief allowance is what? 20% of the rent paid, subject to maximum of the 500,000. Whichever one that is lower. Though what we are trying to say is that your rent relief allowance for individuals who incur what we call who paid for rent in a year of assessment. So if you incur rent, that is, you paid for rent for your house, for where you are living, and that rent you paid, the amount that is available for relief is 20% of your annual rent paid. So far that rent you paid is not greater than 500,000. In the case that where it is greater than 500,000, we are going to use 500,000. But in the case whereby it is what? It's less than 500,000, we are going to use that. You are going to use the whole of the 20% of the annual rent paid. So, for instance, 20% of 1 million is 200,000. So we are going to use 200,000. But in case 20% of 2 million is what? 20% of 2 million is 400,000. Then we are going to allow that 400,000 as a rent relief. But in case whereby we say 20% of 3 million, if you see 20% of 3 million is going to be 600,000. In this case, that 600,000 is not going to be used as a rent relief. How much is going to be used is going to be 500,000. But before you can say the amount of a rent relief, the amount of a rent relief will be, we are going to use we are going to start using 500,000. That's when your total annual rent is greater than that of what refers to as 2.5 million, because 20% of 2.5 million is what give us to what is what will result in 500,000, right? So because if you said okay, if you look into the 20% of 2 million is what gave us to 400,000, and 20% of 3 million of 2.5 million is what is going to result in 500,000. So before we can now say okay, the annual rent and your rent relief allowance is not, and is we are going to start using 500,000. That's when your rent, the total rent you paid, is greater than 2.5 million. Suffice to say that. So for equity calculation. So, but in the most cases, in the best described as by the law, is stating that your rent relief allowance is going to be the lower of 500,000 or 20% of the rent of the actual rent paid, So this rent relief allowance is what is now replacing consolidated relief allowance. And don't forget, your consolidated relief allowance, which is previously the 200,000 or 1% of the gross income plus the what, plus the 20% of the gross income, as earlier mentioned under the previous provision. So it is replacing the consolidated relief allowance, which is what, which is the higher between the 200,000 or 1% of the gross income plus 20% of the gross income. They are between the two. That's what we refer to as what we call the consolidated relief allowance initially. But this consolidated relief allowance has been scrapped out. The only relief allowance that is now applicable is what we refer to as what, rent relief allowance. That's what we refer to as rent relief allowance. That's what we refer to as rent relief allowance. So moving forward, we have what we refer to as rent relief allowance, and that's rent relief allowance coming back to our total taxable income, which results in, after we deduct our total deductions, which will result in our total income. So let's now deduct from our tax to our total income. Now, when we deduct from our total income, eligible deductions, when we subtract eligible deductions from our total income, we are going to have what we refer to as our chargeable income. That's why section 30 subsection 1 of the Nigeria Tax Act 2025 states that our chargeable income is reversed to what? It reversed to the total income less eligible deductions. So we can now say the chargeable income is income which is charged to tax. That is the taxable income that remain after exemptions, relief and deductions. That is why under our calculation in the last time we said okay, when we subtract our eligible deduction from our eligible deduction, which constitutes National Housing Fund contribution, NHIS, the pension, the mortgage interest, life assurance premium and rent relief from our total income, that's what gave us our chargeable income. So let's quickly look into what refers to our chargeable income. So our chargeable income is the portion of the taxable income that remain after deducting allowable reliefs, exemptions and deduction upon which tax is actually charged at the appropriate applicable tax rate. So the part of the taxable income that is later being charged to tax is what we refer to as what? As our chargeable income. So it is the final tax base. So the chargeable income answers the question, how much of this taxable income will actually be taxed? How much of this taxable income will actually be taxed? That is why we said okay, for calculation purposes, that is why the section 30 subsection 1 of the Nigeria Tax Act states that the chargeable income of an individual for any year of assessment is the total income of the individual ascertained in accordance with the provision of the section 28 of this act less eligible deduction. You see, the total income less eligible deduction. The total income less eligible deduction. Those are the two major things. That is why we say for calculation purpose is going to be our chargeable income is the total income less eligible deduction. So that is why when we deduct our eligible deduction from your taxable income, that is why we get our chargeable income. It's upon this chargeable income we are now going to say, okay, we have the appropriate applicable tax rate, which we mentioned initially, which is for the first 800,000 is 0%, for the next 2.2 million is 15%, for the next 9 million is 18%, for the next 13 million is 21%, for the next 25 million is 23%, and for the next 50 for above 50 million rather, for above 50 million, that is what results in 25%, and the total of what we get for as tax is what we refer to as our tax for the period. So if in case the taxable income there has been a certain deductions for as tax, like withholding tax has already been paid on this income, such withholding tax has already been paid will be subtracted from the total tax payable that we computed to get our tax liability for the period. We are still going to see what that difference between tax payable and tax liability in a year of assessment, but I want you to follow through. So let's now look into the difference between taxable income and chargeable income for better understanding of people that are watching out. What is the taxable income? So as earlier mentioned, I said taxable income refers to total income, profit or gain of an individual from all sources which are taxed under the law, which are taxed under the law, which the tax law, that is what we said, which the tax law recognizes as liable to tax within a basis period, whether or not such income will eventually be taxed as after relief and exemptions. Whether we are going to say, okay, this income is going to be taxed or not, whether we are going to still charge it to tax, but they are taxable because it answers the question which income is legally capable of being taxed. So that is why we said according to section 28 we list those income which meets these definitions. So we can, and earlier mentioned as the chargeable income, I said the chargeable income is a portion of the taxable income that remain after deducting all allowable relief, exemptions and deduction, on which tax is eventually charged as applicable tax rates. So what we charge to tax, which we refer to as refined tax base, is what we refer to as chargeable income. Don't forget, under normal circumstance, your taxable income is what we call the tax base. What we are levying tax on is what we call tax base. But upon what we later charge, or what we later levy tax on is what we call chargeable income. So we are still going. That is why I said, okay, chargeable income answer the question how much of the taxable income is eventually taxed, and that we can say our chargeable income is your taxable income less total deduction less eligible deduction. When you remove your eligible deduction and your total deduction from your taxable income, we are going to have what we call your chargeable income, because for us to get our total income, our total income is what we call the taxable income minus eligible deduction. Suffice to say that our chargeable income is the taxable income minus total deductions minus eligible deductions. So you could see the difference now. So it's obvious to say that all chargeable income is taxable income, but not all taxable income becomes chargeable income. Can I take that again? So all chargeable income is taxable income, but not all taxable income is chargeable income, because taxable income, not all taxable income later become chargeable. So that is why we say all chargeable income is taxable income, but not all taxable income becomes chargeable income. It's not all taxable income becomes chargeable income. So for better explanation, we can say the taxable income refers to income that is subject to tax. Income that is subject to tax under the law, while the chargeable income is the whole or portion of such income subject to tax, that is income, that is taxable income, that is later charged to tax. Let me tell you that again. If the chargeable income is the whole or portion of such income that is subject to tax. Income that is subject to tax is what it refers to as what? As taxable income. But the whole or portion of that income that is subject to tax that is later charged to tax as appropriate applicable rate is what we refer to as the what? Chargeable income. So chargeable income is what? Is the whole or portion. The reason why I use whole, there are some instances where your taxable income may be equal to your chargeable income. That is what we use whole. So or portion of that taxable income that is charged to tax at applicable tax rate is what we refer to as what? As what we refer to as chargeable income. What do we mean by something is subject to tax? Subject to tax, when we say something is subject to tax, when an income is subject to tax, it means that the income fall within the scope of tax law. When we say, okay, something is subject to tax, simply means is within the scope of tax law. The law recognizes this type of income as taxable in principle. So it answers the question, does the tax law cover this type of income? That is why section 28 subsection 2A of Nigeria Tax Act 2025 tells us what are the taxable income. So that is why we say subjected to tax simply means is within the scope of what? Of taxation. But when we say charge to tax, when we say an income is charged to tax, it means that tax is actually computed. Tax is actually computed and imposed on it for that year. So the income upon which tax is imposed on, or tax is computed on, is what we call charge to tax. That's what we call chargeable income. So it answers the question, after the exemptions, after the relief, after the deduction, the income upon which tax is payable on is referred to as what we call chargeable income. Okay, this income, this is where upon it, that's what we are levying our tax on. So in short, we can just say that, okay, the subject to tax is when that income is subject to tax when it is recognized by the law as taxable in principle, but it is only charged to tax when it is actually computed and imposed on it after all exemptions and relief. So when tax is later, let me take that again. In short, income is subject to tax when it is recognized by the law as taxable in principle, but it is only charged to tax when tax is actually computed and imposed on it after applying exemptions and the relief that is available in the tax law. So that is why we said taxable income is reversed to income that is subject to tax under the law, while the chargeable income is the whole or portion of such income that is subject to tax. So we can just say, suffice to say, that our taxable income is the income upon which tax may be levied under the law, while the chargeable income is a portion of that income upon which tax is actually levied after relief and exemptions. Or we can just put it as the taxable income represents the what? Represents the income that is capable of being taxed, whereas the chargeable income represents the income which is actually taxed. You see that now? So that is what we refer to as, that's the difference between taxable income and chargeable income. So when we now get our chargeable income, we now say, okay, you see, that is why we apply the applicable tax rate to the what? To chargeable income at what? At this, we have the applicable tax rate 0% for the first 800,000, for the next 2.2 million, 15% at it is what? It is progressive. It is progressive. So we've understood how we get this. The next thing for us is to do to what we call we should do the calculation. The next thing for us is to do the calculation, so that you have the better understanding of how to calculate these things. You already understand the theoretical part, because if philosopher said theory without practice, it is what? Theory that without practice, it is barren, while the practice without theory, it is blind. Both of them work in hand. You've understood the theory, it is now for us to practice. So when you understood the theory and you don't practice, it is barren, because it's not going to yield the result, because we don't know if you truly understood what we've taught you so far. But practice without theory, when you are practicing, you are doing something without understanding the theoretical base, then we could say you are blind, because you are going to be walking blindly, because you don't have a framework that guides your preparation. So theory without practice, it is what? It is barren, while practice without theory, it is blind. So for this fact, we are moving to the calculation part now. We are moving to the calculation part for you to understand how to calculate the income tax in respect to an individual. Thank you. My name once again is Victor Olamide Atunda. Watch out for the part 3 of personal income tax for individuals. God bless you. Have a wonderful day.